Thank you all for tuning in and supporting the channel. Your time and attention mean everything to us. And we're excited to continue bringing you valuable insights. Stay with us as we dive deeper into the world of stock exchanges and financial markets in today's episode. Stock exchanges are the backbone of financial markets, where securities like stocks and bonds are traded. This chapter breaks down the key functions of stock exchanges and explains the difference between primary and secondary markets, as well as the lesser-known third and fourth markets. You'll also learn why liquidity and market depth are crucial for smooth trading, and how emerging technologies like blockchain are transforming these platforms. Chapter 7: What is a stock exchange? Stock exchanges are integral components of the global financial system, providing platforms where buyers and sellers can interact to trade securities such as stocks, bonds, and other financial instruments. A solid understanding of stock exchanges, coupled with the distinctions between primary and secondary markets, is essential for anyone looking to navigate the financial markets effectively. This chapter will define stock exchanges, explore the differences between primary and secondary markets, including the lesser-known third and fourth markets, and highlight the importance of liquidity, market depth, and volatility. It will also provide a deeper look into market participants and discuss the influence of emerging technologies. Definition and purpose of stock exchanges. A stock exchange is a regulated marketplace where securities are bought and sold. It provides a structured and transparent environment that ensures efficient trade execution, fair pricing, and investor protection. Stock exchanges play a fundamental role in the global economy by enabling companies to raise capital, promoting liquidity, and supporting price discovery. Key functions of stock exchanges: facilitating capital raising. Companies issue new shares to the public through initial public offerings, IPOs, on stock exchanges, raising essential capital for growth and expansion. Example: a technology company listing on the New York Stock Exchange, NYSE, raises millions by issuing shares to the public. Providing liquidity. Stock exchanges offer a venue for investors to buy and sell shares easily. This ensures liquidity, allowing assets to be converted into cash with minimal price disruption. Example: the shares of large companies like Apple are highly liquid, trading millions of shares daily with small price changes. In contrast, small cap stocks often experience sharp price fluctuations due to their limited liquidity. Ensuring price discovery. Prices of securities are determined by the interplay of supply and demand in the market, ensuring that prices reflect all available information. Example: the market price of a company's stock adjusts in real time based on earnings announcements, market sentiment, or external events like changes in interest rates or geopolitical developments. The recent response of a major tech company's stock to an unfavorable earnings report is an example of how market sentiment drives price discovery. Regulating trading activities. Stock exchanges impose rules and regulations to maintain market integrity, ensuring fairness and transparency, while protecting investors from fraud or manipulation. Example: the Nasdaq enforces strict listing requirements to protect market participants from unreliable or volatile stocks. The role of the S&P 500 index. The S&P 500 index is one of the most widely followed stock market indices, representing the performance of 500 large-cap companies listed on U.S. stock exchanges. It serves as a benchmark for the overall health of the stock market, and is frequently used by investors to gauge market trends, economic conditions, and the general performance of the U.S. economy. Key characteristics of the S&P 500 Index. Diverse representation. The S&P 500 includes companies from various sectors, such as technology, healthcare, financial services, and consumer goods. This diversity helps provide a comprehensive view of the market. Market capitalization weighted. Companies in the S&P 500 are weighted based on their market capitalization, meaning larger companies like Apple, Microsoft, and Amazon have a more significant impact on the index's movement than smaller companies. Market sentiment indicator. The index often reflects broader market sentiment. For example, during periods of economic uncertainty or major geopolitical events, the S&P 500 may experience significant volatility, highlighting its role as a barometer for investor confidence. Example of market impact. In March 2020, the onset of the COVID-19 pandemic caused the S&P 500 to drop by over 30%, reflecting widespread market panic. Conversely, as the economy recovered and interest rates remained low, the S&P 500 surged to record highs, signaling renewed investor optimism. Using the S&P 500 for investment strategies. Investors frequently use the S&P 500 as a benchmark for portfolio performance. Many mutual funds and exchange-traded funds, ETFs, are designed to replicate the performance of the S&P 500, providing investors with exposure to a broad spectrum of the U.S. stock market. Differences between primary and secondary markets. The stock market can be divided into two distinct types of markets: primary and secondary markets. Each serves different purposes and stages in a securities life cycle, and understanding these differences is crucial for any investor. Primary market. The primary market is where new securities are issued and sold to investors for the first time. Companies raise capital in the primary market by offering shares directly to the public through an IPO or other types of offerings. Key characteristics of the primary market. Issuance of new securities. New shares are issued by companies to raise capital. Underwriting. Investment banks often underwrite the process, helping companies determine the right offering price and ensure successful share sales. Direct transactions. Sales occur directly between the issuing company and the investors. Example: a tech company sells 2 million shares during its IPO at $30 per share, raising $60 million for expansion. Secondary market. The secondary market involves trading securities after they have been issued in the primary market. In this market, investors buy and sell existing securities among themselves, without directly involving the issuing company. Key characteristics of the secondary market. Trading of existing securities. Stocks are traded between investors, and no new capital is raised by the issuing company. Market makers. These intermediaries provide liquidity by facilitating buy and sell orders in the market. Price discovery. Stock prices fluctuate based on market conditions, investor sentiment, and company performance. Example: an investor who purchased shares in an IPO can sell those shares on the NYSE at a higher price in the secondary market. Third and fourth markets. In addition to the primary and secondary markets, there are specialized trading venues known as the third and fourth markets, primarily for institutional traders. Third market. This market involves the over-the-counter, OTC, trading of listed securities, often among large institutional investors. Example: a pension fund manager might buy a large block of shares directly from another institution, avoiding price movements on the exchange. Fourth market. This market involves direct trading between institutional investors, bypassing exchanges and brokers through electronic communication networks, ECNs. Example: two hedge funds might negotiate a large transaction privately using an ECN to reduce costs and avoid affecting stock prices. Expanding on the significance of third and fourth markets. The third and fourth markets play a crucial role in providing additional liquidity and flexibility for large institutional investors. They allow for the execution of large trades without impacting prices on public exchanges, and offer cost savings by bypassing traditional brokerage fees. The growth of these markets reflects the increasing sophistication of institutional trading and the demand for more efficient trading mechanisms. Importance of liquidity and market depth. Liquidity refers to how easily an asset can be bought or sold without causing a significant impact on its price. The presence of high liquidity ensures that securities can be traded smoothly, whereas low liquidity can cause price swings. High liquidity. Stocks with high trading volumes, like Apple or Microsoft, allow investors to easily buy or sell large quantities without significantly affecting the price. Example: a hedge fund selling 100,000 shares of Microsoft may do so without causing major price changes due to high liquidity. Low liquidity. Stocks with lower volumes, such as small-cap stocks, can experience sharp price changes due to even modest-sized trades. Example: a small-cap stock with limited daily trading volume might experience a sharp price drop if a large investor sells their shares. Market depth refers to the market's ability to absorb large buy or sell orders without causing significant price fluctuations. Example: shares of large companies like Amazon often exhibit substantial depth, allowing for significant trades without sharp price fluctuations. Market volatility. Volatility measures the frequency and magnitude of price changes in a stock. Market volatility can be triggered by several factors. Factors influencing volatility. Economic indicators. Changes in inflation, employment figures, and GDP growth can influence stock prices. Example: a sharp increase in inflation might lead to fears of interest rate hikes by the Federal Reserve, causing a decline in stock prices. Geopolitical events. Political instability or global conflicts can create uncertainty, affecting investor confidence. Example: the outbreak of war in a major oil-producing region could lead to a surge in oil prices and increased market volatility. Interest rates. Central bank decisions on interest rates can have a profound impact on market sentiment. Example: a surprise interest rate cut by the European Central Bank could boost investor confidence and lead to a stock market rally. Company-specific news. Earnings reports, product launches, or management changes can lead to significant fluctuations in a company's stock price. Example: a pharmaceutical company's stock price might soar after the FDA approves its new blockbuster drug. Impact on investors. Volatility introduces uncertainty, potentially leading to both significant gains and losses. Risk management strategies. Diversification. Reducing exposure to risk by investing in a variety of asset classes. Dollar cost averaging. Regularly investing fixed amounts, regardless of market fluctuations, to mitigate the impact of volatility. Stop-loss orders. Setting predetermined price points to automatically sell stocks and limit losses. Expanded discussion on market participants. Several key participants shape the dynamics of the stock market. High-frequency traders, HFTs. These participants use algorithms to execute trades at high speeds, seeking small profits from short-term price movements. While HFTs can enhance liquidity, their rapid transactions can also contribute to market volatility. A deeper look into HFTs. HFTs operate on the principle of exploiting minute price discrepancies and executing a high volume of trades in milliseconds. Their strategies often involve market making, arbitrage, and order anticipation. While HFTs can add liquidity to the market, their actions can also exacerbate volatility, especially during periods of market stress. Concerns have been raised about their potential to manipulate markets and create unfair advantages. Institutional investors, pension funds, mutual funds, and hedge funds represent significant market players whose large trades can influence stock prices. Their sheer size allows them to drive market trends and influence the performance of individual stocks. Institutional investors and market trends. Institutional investors play a crucial role in shaping market trends due to their substantial assets under management. Their investment decisions, driven by factors like economic forecasts, industry analysis, and risk appetite, can create significant buying or selling pressure on specific stocks or sectors. For instance, a major pension fund deciding to increase its allocation to renewable energy companies could lead to a surge in demand for those stocks, driving up their prices and potentially influencing the direction of the entire sector. Regulatory bodies, SEC. The Securities and Exchange Commission, SEC, ensures that markets operate fairly and transparently. Its role includes enforcing laws against market manipulation, regulating IPOs, and overseeing electronic exchanges. The SEC's role in market integrity. The SEC plays a vital role in maintaining market integrity by enforcing regulations that promote fairness, transparency, and investor protection. It sets rules for public company disclosures, investigates potential market manipulation, and oversees the activities of stock exchanges. The SEC's enforcement actions serve as a deterrent against fraudulent activities and help ensure a level playing field for all market participants. Emerging trends in stock exchanges. The global financial landscape is constantly evolving, with emerging technologies and sustainable investing practices reshaping the dynamics of stock exchanges. Technology's impact on stock exchanges. Blockchain technology. Blockchain technology has the potential to revolutionize stock exchanges by enabling faster, more secure, and transparent transactions. It can streamline processes like trade settlement and reduce the need for intermediaries, leading to lower costs and increased efficiency. Artificial intelligence, AI. AI is being increasingly used in stock exchanges for tasks like algorithmic trading, risk management, and fraud detection. AI-powered tools can analyze vast amounts of data to identify patterns and make predictions, helping investors make more informed decisions. Sustainable investing and its growing importance. Sustainable investing, also known as ESG, environmental, social, and governance investing, is gaining momentum as investors increasingly consider the impact of their investments on society and the environment. Stock exchanges are adapting to this trend by incorporating ESG factors into their listing requirements and providing tools for investors to evaluate the sustainability performance of companies. Conclusion. Stock exchanges play a vital role in facilitating capital raising, providing liquidity, and enabling price discovery in financial markets. Understanding the distinctions between primary and secondary markets, the importance of liquidity and market depth, and the influence of volatility is crucial for investors. Furthermore, market participants like high-frequency traders, institutional investors, and regulatory bodies such as the SEC shape the market dynamics that influence prices and trends. Actionable insights for investors. Stay informed. Keep abreast of market news, economic indicators, and company-specific developments to make informed investment decisions. Diversify your portfolio. Spread your investments across different asset classes, sectors, and geographic regions to manage risk. Consider long-term goals. Align your investment strategy with your financial goals and risk tolerance. Seek professional advice. Consult with a financial advisor to develop a personalized investment plan that meets your specific needs.